You have $50,000 saved. You have been saving it for longer than you want to admit, and now it is sitting in an account earning just enough interest to feel like a bad joke. Two people you know are telling you two completely different things about what to do with it. One of them just bought a rental property. He talks about it constantly. The tenant, the mortgage, the equity, the tax benefits. He sounds like someone who figured something out. The other one put everything into a total market index fund and adds to it every month automatically. He has a brokerage statement and a boring answer when people ask what he owns. Everyone has an opinion on which one wins. Almost nobody has done the real math over 20 years. We did. And the answer is not what either side wants you to hear. Here is the fair setup. Steve uses his $50,000 as a 20% down payment on a $250,000 rental house. He borrows $200,000 on a 30-year fixed mortgage at 7%, which puts his principal and interest payment at about $1,330 a month. Simon takes the same $50,000 and puts it into a total U.S. stock market index fund, then adds $300 every month on autopilot. For the core model, we are using 8% annual returns for Simon, not 10, because 8% is the number that fits the conservative base case, honestly. If we use the full historical 10% benchmark, Simon finishes much higher, and we will show you that later. Same starting point. Same $50,000, two completely different decisions. 20 years. Let's run it. On paper, Steve feels like a genius. The rent is $1,800. The mortgage is $1,330. That looks like $470 a month in profit before he thinks about anything else. Simon feels like nothing is happening. No tenant, no driveway, no asset he can point at from the road. But that $470 is not profit. It is just the gap between rent and mortgage. In the first year, once you subtract only property tax and insurance, Steve is down to roughly $1,133 for the entire year. That is about $94 a month before a single vacancy, repair, or turnover cost. That is the first big bend in the story. The rent check is revenue, not take-home pay. By year 3, Steve has seen what landlord math feels like in real life. A $1,200 water heater, a $2,800 roof repair, one vacant month, another $600 to clean and relist the place. His cumulative cash flow after 3 years is slightly negative, even though the property has appreciated and he has paid down a little mortgage principal. He is ahead in net worth, but he is not ahead in peace. He has also spent about 175 hours dealing with the property because in the base case, he manages it himself. If he hires a manager instead, that costs somewhere between 8% and 12% of rent collected. Either way, the property is not passive. This is the part real estate investors skip. The spreadsheet makes it look like an investment, but for long stretches it behaves like a side business. Simon has spent approximately 4 hours looking at his brokerage app. By year 5, Steve gets the kind of bill that changes how you talk about cash flow. An $8,500 roof. By year 7, there is also a $1,400 plumbing hit. Even with those costs, his leverage keeps helping him. Steve's net worth is about $102,500 at year 5 and about $131,500 at year 7. Simon still looks boring, but the curve is starting to matter. At 8%, he is around $96,500 at year 5 and about $121,000 at year 7. What is changing is the engine. Steve's wealth is being pulled up by leverage and appreciation. Simon's wealth is being pushed up by compounding. And compounding is slow right up until it suddenly is not. Here is where it gets interesting. Because if you think the gap is obvious at year 7, wait until you see what happens at year 10. And then wait until you see what happens at year 20. Because one number in this story is going to hit you in a way you are not expecting. At year 10, the gap that looked obvious at the start has almost disappeared. Steve's house is worth about $352,650. he still owes about $171,625. That leaves him with about $181,000 of equity. And after adding his cumulative cash flow, he sits at around $184,400 in total net worth. Simon, with the same initial $50,000 and just $300 a month added automatically, is at around $165,900. So yes, Steve is still ahead in the conservative base case, but he got there by taking on debt, concentrating everything into one property, handling repairs, eating turnover risk, and spending roughly 565 hours managing the asset. Simon got to almost the same number with maybe a dozen light-touch review hours over the entire decade. And here is the detail that will make every self-managing landlord pause. If Steve had hired an 8% property manager instead of doing the work himself, his year 10 result drops to about $165,900, which is basically identical to Simon. Same money. One of them spent 565 hours getting there. Now, for the year 20 number that changes the conversation entirely. Steve's house is worth about $497,400. But here is the line that almost every comparison forgets to show you. The mortgage is not paid off. After 20 years on a 30-year mortgage, Steve still owes about $114,600. That remaining balance sits there in red on the spreadsheet, while every headline about property wealth shows you the gross value and not the net position. Subtract the debt. Steve has roughly $382,800 in equity. Add in his cumulative net cash flow over 20 years, and he lands at about $425,800. Simon, at 8% and $300 a month, lands at about $423,000. After 20 years, a near tie in dollars, but it is not a tie in effort. Steve spent about 1,114 hours managing the property across those 20 years. If you value that time at just $25 an hour, that is another $27,850 the napkin math never counted. At that point, Simon is ahead. And the gap widens even faster if Simon does something very boring and very powerful. Increase the monthly contribution from $300 to $500. At that point, he finishes at about $540,900. And if we use the full historical 10% benchmark instead of the conservative 8%, he finishes at around $594,200. That is where the zeros show up. But before anyone declares a winner, there is one more scenario that does not get talked about enough. What happens when the market moves against you? At year 10, Steve has about $181,000 in equity. If home prices fall 10%, his equity falls to about $145,800. That is almost a 20% hit to his wealth from just a 10% move in the asset. If home prices fall 30%, his equity drops to roughly $75,200. That is a 58% hit. Simon gets hit too. If the market drops 10%, his year 10 portfolio falls from about $165,900 to about $149,300. If it drops 30%, he falls to about $116,100. Painful. But the loss is not magnified by debt in the same way. Leverage makes good outcomes look better, and bad outcomes feel much worse. That is the cleanest way to say it. So who wins? Steve wins if you want leverage, do not mind concentration, and are willing to operate a small business for years in exchange for the upside that comes with it. In the right market, with the right property managed well, real estate absolutely wins. House hacking especially changes the maths entirely because it cuts your own housing cost at the same time as building equity. And that dual benefit is not a fair comparison to a standard rental. Simon wins if you value simplicity, diversification, liquidity, and the freedom to let compounding work without a second job attached to it. The index fund does not call you about a water heater. It does not have a vacancy month. It does not require 1,114 hours of your life over 20 years. The real trap is not choosing real estate. The real trap is not choosing stocks. The real trap is pretending the answer is obvious before you have counted everything. The mortgage that is not paid off. The hours that were never on the spreadsheet. The time that compounding needed to become dangerous. Next time somebody tells you property always wins or index funds always win, ask one question. Did you include everything?